Ladies and gentlemen, yet another quarter has passed, and it's time for Scania to present its second interim report of 2013. Welcome to this press and web conference. In a moment, we will listen to Jan Ytterberg, Scania's CFO, for a presentation of the financials. But first, for me to introduce Martin Lundstedt, President and CEO. Please, the floor is yours.
Thank you, Eric. Thanks a lot. And welcome here. Good to see you all here. So also from my side, welcome to this quarter two presentation from Scania. In general, to start with, demand for new vehicles globally has been on a fairly good level for Scania, with improvements in order intake both sequentially with approximately 9% and year-on-year with 15%. Total vehicle orders amounted to 22,500 in quarter two and 43,300 vehicles for the first half of 2013. In Europe, during quarter two, truck orders were clearly higher and close to 10,000 units, and also Latin America continued on good levels. On the other hand, as you know, currency is still a significant headwind, not at least during the quarter with the weakening Brazilian real. We have also increased cost due to investments in more production capacity that we are building up. We have investments in more sales and service capacity, not at least in emerging markets, and that we are starting up our operation in India. In addition to that, we are continuing with high ambition levels in our research and development area, with further improving customer offerings for the future, but also considerable amount of resources to continue to roll out the complete range of Euro 6 range. Also during the second quarter, we started to prepare for a higher production rate in the European system, since we are planning to increase the European production in two steps during the fall. The utilization fee in Russia is still not fully compensated out to the end customers. So all in all, the cost level was high. We continue to successfully develop the service offering, and more service volume is coming in, but the currency effects offset, so we have a fairly stable service revenue as a total. In Europe, order intake was close to 10,000 units, and we have actually to go back to the first quarter of 2008 to see a higher level than we had in quarter two. In first quarter 2008, we had 10,400 units. April was very good, but also May and June continued on good levels. We have several times reiterated that there is a replacement need out in the markets, not at least in Southern Europe, since we have had very low deliveries in recent years. And we also start to feel that there are some support from pre-buy activities in Euro 5 vehicles. We can see good levels in the UK in quarter two. 25% of the orders were coming from the UK out of the 10,000. Also in the Nordic region, we saw high numbers. Those are typical markets without any clear incentives, and they are more likely to invest in Euro 5 machines for the time being. There are also markets with some incentives like Switzerland and Netherlands, and there we benefit from that. We have a very strong position in the Euro 6 range. So in general, we are in a positive momentum in the market, and one reason is our Euro 6 range. In total, we have improved our market shares in the European region with somewhat more than 1 percentage point. And in order to keep the momentum, we continue to focus on short lead times and not to build up any significant order backlog. And one important introduction that we have made is the new Streamline that has been well received both by the press and by customers. There is still a very competitive and challenging pricing environment in many European markets, but we are using the Streamline introduction to improve pricing, since we are offering clearly more customer value to our end customers. As order intake is improving, production will be ramped up during the autumn to keep our short delivery times. We have at several occasions presented our broad and competitive Euro 6 range, and we now have a very good track record when we have tested together with many customers out in different markets and for different applications. We launched the first engines already in the spring of 2011 and started deliveries at the beginning of 2012. And so far we have delivered some 3,000 units. And it is a very high priority for Scania right now to go into next year with a full and complete range of performance steps of Euro 6. And as I said, with a proven record of millions of kilometers driven by customers in different applications, so we have the right performance. Because Euro 6 is a very big step. So together with the launch of the Streamline and our second generation Euro 6 engines, we have strengthened our position further. And one very good example that we are introducing now is our 410 horsepower SCR only engine that will be used among many European fleets. We are also now rolling out Euro 6 models for alternative fuels, and we have delivered the first gas truck in the Nordic region. In Latin America, demand continued on a very good level. There are subsidies that were put in place last year, and they will continue also for the second semester of 2013. In Brazil, interest rate will go from 3 to 4% in the FINAME system, but still clearly below the inflation rate. We also have confirmation that Argentina will continue subsidies during the second semester of 2013. As in Europe, we have a good momentum in the market share development in mainly Brazil, and that pattern we have seen since the introduction of Euro 5 at the beginning of last year, when we did choose the strategy not having a big buffer of Euro 3 trucks and moved more quickly into the Euro 5 situation. That, and in addition to that, our entry into the semi-pesado or semi-heavy vehicles, what we at Scania call the light to heavy distribution, has given also additional volumes and a positive development for Scania in Brazil, and therefore we have gained a considerable market share. Russia is on a good level, although orders were a little bit lower than Q2 last year. We are also starting to compensate for the introduced utilization fee, but it will be done gradually and give full effect later this year. We have a situation where some manufacturers do not have to pay, and it is still uncertain, but our estimation is that during the fall, we will have the same fee for all manufacturers. Scania, as you know, has a strong position in Russia, and market shares have been improved during the first semester. Investment in expanded sales and service capacity continues as planned. Middle East continues to be unstable, and demand remains at very low levels. We have some exceptions. Turkey are taking orders, and we have also seen a positive development in Iraq from low levels, but has started to move. Elsewhere in Asia, we have a stable situation in Southeast Asia, like in countries like Indonesia, as well as Taiwan and Hong Kong. China is weaker year on year, and that is mainly related to the big order we got from concrete pump manufacturer Zoom Lion in Q2 last year, and that has not been repeated due to the weaker construction market in China. As regards buses and coaches, we have been successful during the first semester with a very good order intake in the first quarter, but also in the second quarter. And we have had some large orders from Russia, but also from Asia in countries such as Malaysia and Taiwan. For example, in Russia, we took the big order together with Russia-based group GAZ of 709 buses for the biggest city bus transporter in Moscow region, and those are gradually taken in during the first semester. Scania will in this case deliver chassis modules, and GAZ Group will stand for the body building, and this is also a very important investment for our increased service capacity in the Moscow region. Also, we got an order for 350 buses to Malaysia, and 200 buses to U-Line or U-Trans in Taiwan. That is the single biggest order we have got in Taiwan for buses. The European bus market, on the other hand, continues on a very low level, not at least because of low tender activity in different cities for city bus applications. Although that we, during the second quarter, took some important deals in Poland, in Germany, and in the UK. For engines, order bookings showed sequential improvements, mainly related to Latin America, as different shortages of power supply pull demand for standby gensets, and mainly related then to the 9 and 13-liter engines. In Europe, still low levels for us, even that we have seen some improvements during the last months. And that is, of course, related to our industrial OEMs in Europe and low activities in construction and mining. Then for production, as we have also reiterated several times, we are focusing on short delivery times, not building up order backlog and therefore avoiding speculation and stock build-up. Therefore, on the back on the higher order intake that we have seen both in quarter one and quarter two, we will continue to increase production rate in European system, one step in quarter three and one step in quarter four. To make sure that we have necessary cost flexibility, the majority of the manning we put in is on temporary contracts from manning companies. For the midterm also, to meet future volume targets, we are investing in more technical capacity that is ongoing right now, and mainly in the European system, from 100,000 annual capacity on a global basis up to 120,000. The demand for 120,000 vehicles for Scania is not there yet, but as you know, we have a lead time of approximately 2 to 3 years to do this investment, so we are continuing, so we will be ready when demand will be there. In services, the revenues, as I said, is stable, although that we saw an improvement in both volumes and pricing in local currency. Pricing approximately 2% and volumes approximately 4% during the first semester. Scania is continuing its successful penetration of different service products. One good example is our penetration in repair and maintenance contracts for new vehicle sales that is in many European markets well above 50% today, and in some markets up to 80%. That is giving also for the future very good captive situation for our service business. In addition, more advanced service packages such as Ecolution is continuing to develop according to plan and is really well received by our customers. We are also continuing to invest in service capacity thanks to the increased rolling fleet in many emerging markets. And service volumes are, as a consequence, also growing in markets such as Russia, Brazil, Indonesia, and Poland, thanks to the increased fleet and better service market share. So in summary, we will go into the second half with a higher production rate, thanks to an improved order situation in mainly Europe. Of course, it remains to be seen how much pre-buy we actually have and how that can affect the later part of the year. But flexibility is the name of the game here. And when we increase production in 2 steps during the second semester, flexibility will be one of the key issues. Our competitive position is strong with the new streamlined models and the full range of Euro 6 vehicles, including second generation of Euro 6 engines. Substantial deliveries already to customers of Euro 6 means that we have a good proven record to make a smooth transition for our customers. And the early introduction of Euro 6 is one factor already today behind our improved market share situation in Europe. In Brazil, we did a relative quick transition from Euro 3 to Euro 5 without substantial inventory of the old Euro 3 technology. And since then, we've had a strong performance relative to the total market. Also during the quarter and for the coming quarters, we keep a high activity when it comes to investments. Projects in R&D to strengthen our competitiveness in the coming years, as well as securing the rollout of the complete range of Euro 6 for all engines, fuels, and applications. In addition, we are expanding production and service capacity and continue to develop our service business by taking concepts like Ecolution by Scania to more markets around the globe. With that, I will end the market outlook and leave the word to Jan Ytterberg to present the financial figures. Thank you very much.
Okay, Martin, thank you. We've gained momentum for Scania in the vehicle market. The production has been geared up, especially then in Latin America, where the capacity utilization has been extremely high here during the second quarter. And as Martin mentioned, an increase of production level has been implemented in the beginning of the third quarter in the European production system. We will also then are planning for the next increase in the beginning of the fourth quarter. The leverage from high volumes on operating income was unfortunately limited as the headwind from currencies increased as a consequence of a considerable weakening Brazilian real, and the Brazilian real is the most important currency for Scania as regard net inflow, and also a strong Swedish krona in general. So yet another quarter with some 2 billion of operating income, 2,038 million here in the second quarter for the group, corresponding to an operating margin of 8.9%. And for the first half year 2013, the operating income decreased to 3,971 million, representing then an operating margin of 9.4%. The decrease of close to 300 million compared to the first two quarters last year was mainly then related to the currency effect, the negative currency effect, which was to some extent offset by an increased volumes of truck deliveries and a better capacity utilization in Latin America. We have continued to invest for the future by developing new products, by increasing technical production capacity, and also by expanding the service network into the emerging markets. Subsequently, we have had a high cost and a high investment level. It is, with this number, easy to get blinded by the high vehicle deliveries and the good order bookings, which are partly driven, we must remember that, by short-term temporary events, such as the subsidized financing in Latin America and or the pre-buy effect of Euro 5 vehicles before Euro 6 becomes mandatory. Due to the high uncertainty about the global GDP development and thereby also the underlying demand of our products and services, a continued high cautiousness and financial discipline is still needed in the company. Deliveries. Well, to make a comparison of deliveries for the first two quarters this year is difficult, especially related to Latin America, as last year was negatively affected by the changeover from Euro 3 emission standards to Euro 5, where we entered into 2012 with a rather limited buffer that we sold out of Euro 3 vehicles, and we were facing also hesitant to buy Euro 5 vehicles from the customers in the first half year. And also the demand in Argentina was weak in the first half of 2012. This year, on the other hand, the deliveries of trucks in Latin America were at record high levels, positively affected by subsidized financing in Brazil, but also in Argentina. The deliveries of vehicles increased by 80%, and the deliveries to Latin America of vehicles represented 36% of total vehicle deliveries. As a consequence of this, the capacity utilization and production level were high, and actually we were close to 30,000 vehicles in the Latin American system on a yearly basis of production. During the third quarter, we need to halt production in Latin America for 3 weeks for maintenance, for refurbishment of the factory, and thereby also by that getting some well-deserved vacations down in Latin America. Deliveries increased in general in Europe in the second quarter, and substantially higher were the deliveries in United Kingdom, France, and Poland. The deliveries to trucks into Russia increased with some 15%, whereas other markets in Eurasia decreased deliveries. And bus deliveries increased substantially in Russia, as we are now delivering out the big fleet order we received in the beginning of the year. The decrease of deliveries in Asia of some 20% were related to China and to Indonesia. To run a production efficiently with the volatility we have been facing the last 9-18 months is not easy. The last 3 quarters, the challenge has been on one side of increasing the production and stretch it further in Latin America, whereas we have to adjust production downwards in the European production system, with 7 stop days as a consequence in the beginning of the first quarter, and here in the second quarter, working overtime, working holidays to get up supply in better balance with demand. As a consequence of the increased demand of trucks in Europe, the production rate was increased already in the beginning of July, and the next increase is planned in the beginning of the fourth quarter in Europe. Cost for ramp up in the third quarter affected second quarter negatively. Sale of used vehicles continued to improve in the second quarter. They were up 15% compared to last year. And if we take a look on the first half year, 2013, related then to used vehicle sales, they're up 10%. But as we see on the new trucks, the price pressure are rather high. The same tendency of an improvement of the demand was noticed as regards services as well. Second quarter was positively affected compared to last year due to the Easter. The Easter was in the first quarter last year and in the second quarter last year, and we had no Easter this second quarter. But eliminating the effect of working days, it was encouraging to see the increase of service demand in Europe, both as regards to parts and workshop hours. But service demand continued to be weak in southern part of Europe. And outside Europe, we can see that we see an increase of service volume in general. The slowdown of the mining sector, though, affected some countries negatively, as these vehicles consume around 2 to 3 times services compared to an average truck. So if we take a look on the service revenues, they increased with 6% in local currency for the first half year, but as a consequence of the stronger Swedish krona, they were stable in Swedish krona or in nominal terms. For the second quarter, service revenues increased with 9% in local currencies. And we were up on numbers of sold hours with 150,000 hours in the first half to 4.1 million hours. And as the number of mechanics increased by 3%, we also then experienced an improved productivity and improved capacity utilization out in our workshops. This was then mainly related to Europe, where we have the majority of the captive service network and the majority of the service operation. Europe stands for around 70% of service revenues. The last 5 quarters, it must have been rather easy to analyze in Scania, to be an analyst of Scania. We have been capped around 2 billion per quarter the last 5 quarters since the second quarter 2012. Total net sales increased in the first half with 7% compared to last year, reflecting the 19% increase of deliveries, but this was offset by the stronger Swedish krona that then had a negative impact on net sales with 7%. So if we take a look only in local currencies, we are up 14% on the total group. And the currency effect was substantial since the Brazilian real has been weakening with 13% in average for the first half year against the krona. And at the same time, we have a higher weight of the Brazilian real than we had last year. This year, the Brazilian real, we are invoicing Brazilian real, 22% of total net sales is actually Brazilian real. Other important currencies for Scania were down with 5 to 7% compared to the krona, compared to last year then. And net sales increased with 19% in the second quarter as the deliveries increased with 33% and the stronger krona impacted negatively with 6%. So back to the result then, operating income for the Scania Group, 3,971 million here in the first half, operating margin 9.4%, and in the second quarter, 2,038 million of operating income and an operating margin of 8.9%. If we go a little further down in the income statement, financial net was negatively impacted by the deterioration of interest margin on the net cash position we have, but the net cash position was also somewhat lower than last year. And we have a higher tax rate than last year. We have a tax rate of 29% during the first 2 quarters this year, which then was higher than last year as a higher share of the result was generated in Brazil. And in Brazil, they have 34% of tax rate. So coming down to the net income was close to 2.8 billion in the first half, representing a net margin of 6.6% and an earnings per share of 3.47 Swedish krona. And in the second quarter, net income was close to 1.4 billion. If we try to understand what has happened between the years in the income statement, we have a deterioration of the operating income of some 300 million in vehicles, and that is related to vehicles and service segment, which is then equal to the group. And the one most important factor behind the drop of the result was once again the stronger Swedish krona, which had a net impact on operating income of 1 billion compared to last year. And once again, most substantially are hitting us the weaker real against the krona, minus 13%, in combination then with the unusual high net inflow, reflecting then the high of Brazilian real, reflecting then the high deliveries in Brazil. Other important currencies for Scania as regard net inflow, dollar, Russian ruble and pound sterling were around 5 to 7% weaker compared to last year. And interesting enough, in euro right now we are perfectly hedged. We have 0 net inflow of euro. As Scania is a company with a substantial cost base and net outflow in Swedish krona, this puts a pressure on the margins and on the company to work with efficiency, productivity and focus even harder on cost reductions. If we move over to prices, during the first quarter 2012, we tried to increase prices in general and in Europe particularly. To some extent we were successful, but the volume was hurt, and that was especially the case in Europe. Gradually, we became more opportunistic during 2012 to mitigate the volume drop and the loss of market share. And even though prices sequentially are rather stable, they are, when we compare it with the first half year 2012, lower. To make a comparison as regard prices in Brazil is rather difficult to do, since we are comparing a half year last year with mainly Euro 3 vehicles and a situation of high hesitant to buy Euro 5 vehicles in Brazil, with a year, half year this year with only Euro 5 vehicles. But we can say in general that the price pressure continued to be hard in Brazil despite the strong demand. And also in Europe we see continued high price pressure, and it has been very difficult to get out and compensate ourselves for the higher costs in case of, for instance, Euro 6 vehicles. And as regard Russia, as Martin mentioned, we have so far only been capable to compensate ourselves partly for the scrappage premium that was introduced in September 2012. So that has meant that the margins has been under pressure. If these were the negative side, there are some positive side as well. We have, of course, the increase of vehicle deliveries, mainly truck deliveries. We are talking about 6,000 vehicles compared to last year, first half. And that had, of course, a substantial positive impact on gross income. The capacity utilization in Brazil improved substantially as the number of vehicles produced doubled compared to last year. Last year, though, we must remember the produced volume was exceptionally low as we were changing engine platform in Latin America in the beginning of 2012. And also, as I said before, the demand of Euro 5 vehicles was very subdued in the first half year. All in all, in Latin America, we had some 6 to 8 stop weeks where we had closed the factory or stop days due to demand during the first half last year. This year, on the other hand, the capacity utilization has been extremely and extraordinarily high in Latin America due to the strong demand, and that's why the volume is doubled compared to last year in Latin America. So moving on then and into the balance sheet and cash flow. From a historical perspective, we can say that the cash flow generation has been rather limited in vehicles and service segment, which we see here, as earnings has been deteriorating and net investments were on a high level. As last year, we have tax payments in Brazil for the result in Brazil for prior year that was moved into the this year and been paid then in the beginning of this year, affecting cash flow negatively, and that's why we have income taxes in cash flow being higher than income tax in the income statement. And furthermore, Close to 800 million was paid to a pension trustee in the beginning of the year to reduce the Scania exposure towards the Swedish PRI system that was no longer able to manage the size of Scania, the Swedish operation of Scania in Sweden, then inside their credit exposure criteria. Besides this, the 800 million of pension redemption, the working capital was positively affected by increased trade accounts payables as a consequence of the improved volumes, but that was partly then offset by increased inventory for the same reason, by production parts and components, but also to some extent by complete vehicles. The high ambition in the company, which we have been talking about, affected also the net investments negatively. They were 2.5 billion here in the first half year, whereof 0.5 is then related to capitalized R&D expenditures. So all in all, for the first half year, cash flow 744 million in vehicles and services, and that was fully generated in the second quarter. And if we also add the financial services together with this and get the full group, we had a negative cash flow of 150 million as the financial service portfolio increased. Net cash position in vehicles and service segment was 6.4 billion. That is 3 billion lower since year end. It's a result of two effects. We have the dividend payment of 3.8 billion being paid out to the shareholders in May, and that was partly then offset by the close to 750 million that was generated in cash flow in vehicles and services here in the first two quarters. If we then also this time combine it with financial services, we have a net debt for the group that increased 3.5 billion since year end to 33.7 billion. And when we are talking about financial services, we have experienced a stable situation of financial services this first half year 2013. Credit portfolio increased 1.2 billion since year end in local currencies, that is 3%. And the increase was mainly then related to Brazil and to Germany, where we also have had high deliveries. Finance penetration decreased from 37% last year down to 31% this year, and that is a consequence of the fact that we have a higher share of deliveries in Brazil, and in Brazil we have a lower finance penetration than in the rest of the world in general. So far, we are experiencing financially a muddling through situation, an economic situation of muddling through in our main markets, Europe and in the rest of the world. But that has had limited effect on the transport demand. Thereby, also the payment performance of the customer has in general been good. Overdue situation stable since the end of the year. Bad debts expenses continue to be high in Southern Europe and low elsewhere. So the operating income for the first half year 2013 for financial services 302 million, somewhat lower than last year, but last year we had some bad debts provisions that were dissolved during the second quarter, impacting 2012 positively. So the higher average portfolio compared to last year have impacted positively, but we have also the stronger Swedish krona and a somewhat higher operating expense level that impacted negatively. So if we sum up this from the financial side, we can see that earnings decreased mainly as a consequence of the stronger Swedish krona that strengthened against all important currencies for Scania as regard net inflow. The negative impact of the currency on operating income was 1 billion compared to the first half last year, which was to some extent offset by higher truck deliveries and better capacity utilization in Latin America. And with the gain momentum for Scania in the vehicle market, the production has been geared up in Latin America and also in the European production system as from the beginning of this quarter, the third quarter, where we also will have the next planned increase in the beginning of the fourth quarter. And we have in this situation continued to invest for the future by developing new products, by increasing technical production capacity and expanding our service network into the emerging markets. So we have had in this quarter and in the first part of the year a high cost and investment level. And it's easy to get blinded by the top line, the high vehicle deliveries and the good order bookings, but margins are under pressure both in local currencies and of course especially in Swedish krona. The high demand is partly driven by short-term temporary events and the global economic development is uncertain, and as a consequence a general restrictiveness and cautiousness is needed, and taken decisions might need to be reconsidered. The focus on volume flexibility, efficiency, and cost control must be high, not at least as a consequence of the strong Swedish krona, in which currency Scania has a substantial part of its cost base. By that, Erik, I have finished my part.
Thank you, Jan. Martin, please join us, and we open up for questions. We have microphones for you as usual, and please state your name and affiliation before putting the question. The first question comes from
Fredrik Stahl at UBS. Could I ask you, you mentioned, Jan, that you had a step up in cost. You mentioned India, SG&A, ramp up costs here in the second quarter. Could you quantify those? And then if you have another step up of production in the fourth quarter, you're going to have another step up in cost in the third quarter ahead of that then?
Well, we don't mention exact specific numbers as regard these ramp-up costs, but in general, you can say that at least 2 to 3 months before you do the ramp-up, you have to have the people in. This becomes a little complicated for the fourth quarter because we have vacation, meaning that we have less time to train, meaning that also for partly in the end of the second quarter, we had some costs also for the increase in the fourth quarter. But you can say in the second quarter, we had more or less the full ramp-up cost in the whole second quarter, since this was happening in the beginning of July. But I had waited this question. This is not, so to say, the reason behind maybe the little unexpected lower margins. That is more related to currency as such, and especially then the Brazilian real. Which then, of course, with the headwind we have seen, especially on the currency against towards the end of the quarter, when we had a really hit on the real as such. And that is something we have to live with in the third quarter as well, because it seems that it's not bumping back quickly, at least.
And I think just to add, Jan, I mean, since we have a situation where we are running at full speed in Latin America, and therefore also the possible production increases we can do now is in the European system, and there we have a considerable cost base in Sweden. That is our structure. That is how we have aimed for. And of course we have considered also how should we do with different activities in R&D, in other sectors, service capacity. But so far we have said it's important to continue to build on the momentum we have in emerging markets and also for R&D portfolio. But everything can be reconsidered depending on the future development of, for example, currencies. But we have not taken any short-term actions to be too opportunistic on the currency development.
Can I also ask, in terms of the service business, can you give us an idea what the organic growth is in Europe versus Latin America?
Well, the organic growth is bigger in Latin America, but we are comparing two different systems, because in Latin America we have, especially in Brazil, less of captive network, meaning that we have less of workshop hours, whereas in Europe we have more of a fully integrated service network where we own a big part of the network is then captive by Scania. Let's say like that we did not have as strong momentum in the service side in Latin America first half year that maybe we have seen in the past, but that was more due to the fact that we had internal issues with reshuffling of spare part points, etc. So we were seeing also that we started up the year in Latin America a little slow, especially in Brazil, but came back in the second quarter. But I won't give any exact numbers on the organic growth as such, but of the 6% of local currency increase, 1/3 maybe is prices, 2/3 is organic growth as such, because we are not adding any big, so to say, dealers or importers that affect the service side by acquisition. This is organic growth as such.
And also, of course, Europe as such is very scattered between Southern Europe, where utilization of the fleet is still very low, and some of the countries where we have delivered quite substantial volumes. Poland, for example, is one example where we have seen very good organic growth, both when it comes to the increased rolling fleet, but also penetration in the market share for Scania vehicles, because you have a considerable inflow also of used vehicles coming into Poland. Just to take one example, the same trend we have seen in Russia, that we have a better market share per vehicle, and that is quite long training activity also, how we actually work with the customers to see that we are coming in contact also over the years. What I think is encouraging to see when it comes to the organic growth is that we have the trend in many of the emerging markets that we are capturing a bigger part per vehicle, including then some of the emerging parts of Europe.
Okay, any other questions? I see no hands. Then we thank you for watching this. You know, very good. So in the front.
Rutger Smith from Rivalta. Just a very detailed question. You may have mentioned it before. What is the market share in Russia?
Yeah, the market, Russia is always a very tricky market to measure market share. But you can say if you take the total market, including the domestic players, which you should do, of course, we have an estimated, and I think it's pretty well accurate today, of up to May, because we don't have the figure for June yet, but of 8.1%. And last year we had 6.4%. So even, which is interesting to see also, because even though we have the utilization fee and therefore, and we have compensated partly, not fully yet, that the productivity level of Western European equipment is on a level where still customers are going for that type of equipment, although that we have compensated also part of it for, and also for the second semester we see the same, because we are trying to push out the fee, of course, to the end customer. So I think development is still good in Russia for us, and we are also investing, as I mentioned before, in the Moscow region, in 2 new points in the St. Petersburg region, but also we see a clear trend that our type of equipment is gaining ground also in Eastern Ural or Siberia districts that normally were very much domestic players, but 8.1.
Okay, then we close this. Thank you for attending this press and web conference. We wish you a pleasant summer.